let's talk about the investment essentials. Did you expect that at the Creative Incubator, talking about investment essentials? You did, because you read in the base. Yes. Funnily, I mean, when I share that story, I mean, as a German, by the way, also with an engineering degree, as another cliche, it is very tough for us usually to talk about money. So you should understand, like, from those 2 fucked up wars that we are responsible for, after that time, nobody actually dared to talk about financials because it was a very poor situation, and you didn't want to reveal if you have money, or, you know, it could be risky. So it is still in Germany the case that we don't talk about money. It's very uncommon to ask, like, how much money do you actually earn? Within other cultures, it's actually quite easy. Or if you go to the States and they drive like a SUV car, it's like, hey, whoa, great. How much did you actually buy it for? It's like a common thing. That's not in Germany. So I try to be as relaxed as possible on the topic. And we will start actually with the boring stuff. Then topic is no risk, no fun. Then we will talk about goals and automating your cash flow. So first, the boring stuff. How many of you actually want to own a house or apartment in the future, or already own probably? Can you raise a hand? Well, I would say like 80-90%, right? By the way, it's cool, Eichler homes, right? I don't know if you like them as well. I do. But anyway, are you planning to buy or lease a car, or do you own one already? I mean, raise a hand again. Well, it's kind of the same, 80-90%. So why am I asking that question? Do you know your personal cash flow? I like it. It's the first time that I see people raising a hand here. The thing is, just some of you didn't raise a hand. I mean, it's very simple stuff. The question is, what's a cash inflow and a cash outflow? Just cash inflow is like, hey, what's popping in my pocket right now? Salaries and dividends from investments, etc. While cash outflow is everything that you spend for rent, utility bills, groceries, etc. Can you read? The small letters here? By the way, they do this rich. The thing is, that's the basic. You have to know what comes in and what goes out. I mean, basically, if you downloaded like a cool application from your bank, you have like this round circle, and it's like, hey, wow, I have like an overview. But in reality, you probably don't have a real overview. And because what I want from you, and as I said, this is for you, right? And if you don't do the basics, you can't go a step further. And I know some people in here have some business on their own. They probably think like, hey, that guy is stupid. I do it every day. As I said, this is the basics. Because what I want you to actually not tell me, that's again the German thing. I don't want you to reveal that to me. But I want you to answer for yourself your profit after tax, which is basically the total revenue, everything that comes in, and the sum of the expenses. And this is something that you have to know. The good thing is, since you like spreadsheets so much, later on you will actually receive a spreadsheet from me where you can actually put in your cash inflow and your cash outflow, and then you have what's over under this line. You actually have this as a result. So I even provide you with something which is like a great spreadsheet where you can do that. Because out of that, the next question would be, do you have a personal balance sheet? I'm sure you all have. right? There's one person like, whoa, I have slightly two. Why do I know those two people from the, oh, there's now a third one. It's now popping up. It's now popping up. You dare. Because, yes, that's, no, it's not bad liquid acid and it's not liquid acid or something like that. Oh.
Ich bin flüssig, which also in English you say liquidity, comes from 200 years ago, where water was dirty. Drinking water would have killed you. Washing yourself would have killed you. That's why French had all this powder. And so instead of water, you would have in average drunk 5 liters of wine a day. 5 liters of wine a day. Now that's not the wine had like almost half the. Sorry, Axel, this is 2 minutes. So you do that, and therefore the churches and the rich community had up to 20 million liters of wine every year, and if they were short of money, they would pay their employees, and the government buy liters of wine. Back to you.
I like that side note. Because if you look at two things within a personal balance sheet, it is assets and liabilities. So assets, there's a difference between liquid assets, so everything that you can very easily make to money again if you own it. And then large assets, it might be a house, a car, a boat, etc. And then there are investments, which is a difference to the two previous ones. And on the other hand side, you have liabilities, so something that you owe to someone, open bills, payments, etc. And out of that, you can actually, I don't know if you still know the Monopoly man, you can actually calculate your net worth. This is like when super duper rich actually go out and tell, like, I have a net worth of blah, blah, blah. This is basically it. It's a calculation of those two, and this is what you should do as well. And to give you an example, so even making it more easy, assets you write down what you own in real estate, stock, bonds, securities, cash, gold, commodities, art. I'm sure we all have all of them. Liabilities, your loan, debts, etc. And then assets minus liabilities means net worth. The good news is you will get a spreadsheet on that as well, so you can do that later on. But let's look rather at what is actually better for your net worth. Is it that fancy car up there or that fancy car? I mean, we can argue if it's fancy. What do you like more? What do you think is better for your net worth? The old one, yeah. And it's the old timer. Does anyone think differently? And rather the Tesla?
For your net worth, it's cheaper on the long run.
I'm not answering right now.
It also depends on what worth is.
Yeah. You don't lose that so much. You say it depends on what worth is defined. Yeah. Yeah. Yeah.
The Tesla will basically lose value over time, whereas the old timer will
Yeah. And it's all good things, especially like with the worth. I mean, you define actually what's worth to you, right? I'm talking about financials, obviously, which is cash in the end. I mean, just to give you an example, that's a Shelby 260 Cobra CX blah, 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 and it was sold for, the upper one, and I think, if I'm right, it was sold for 13.75 million. The interesting part is, I don't know if you ever bought a car. The moment when you actually bought a car, and the moment you open the door, you already lost 11% of value of a car. So like, hey, my new car, opening door, 11%, gone. And it's probably better to buy a car after 3 years because it gets super cheap. It's still a good car, and you actually get it. I mean, it's like simple thinkings here. But what about the other pictures? What do you think actually is a liquid asset, a large asset, a consumer good? A consumer good. What's a consumer good for you on this picture?
An iPhone.
An iPhone. What about this one? For the ones, it's a brand called Antisocial Social Club, and I think the other one is Off-White. Is that a consumer good? Yes, no? Yes, I see some yes. Is there somebody who says no?
It depends.
It depends. Why?
There is a very short amount of T-shirts and stuff like that, so they have a value. If you buy one and you sell the next day, you
Yep.
get the double the money.
Yeah.
Exactly.
Yeah.
Which
True.
is stupid, but
Yeah. Yeah. So it could be an investment because if you sell it on the same day, you come out of a shop, it's a limited amount, and you probably sell it for a higher price, multiple times, right? So it is actually difficult to answer that. Like, for example, even the couch, that's a Hans J. Wegener couch built somewhere in the 50s, which is now multiple times worth than its original value. So it's like actually like a good liquid asset because you would get rid of it quite soon. But as you can see here with those easy examples, it's actually not that easy to define what is something like a consumer good, and it burns money, open the door of a car when you come in. So since most of you, 90% actually said, what do you think about a real estate asset? Is that a consumer good? Is that something good, bad from an investment or for your net worth? Depends on the market. Where it is, yeah, yeah. Anything else?
I think it's always good.
It's always good? So let me ask the next question. Buying a house or buying to rent while still renting yourself? So you buy a house, you rent it out, and you yourself rent an apartment. So you don't live in that house that you just bought or apartment. What do you think is better?
I think it's better that option.
Mm-hmm.
Because you can have a profit between what you're renting the house that you own.
Mm-hmm.
You rent it at a higher price.
Mm-hmm.
And you can live somewhere that is cheaper.
Yeah.
And you get that profit.
Yeah.
So probably that option is better.
Mm-hmm.
Of the two.
I mean, first of all, you should be happy, right? And whatever you do, you should be happy with that. That's the first thing. So if you want to build your dream house and you can afford it, why not? I mean, but on the other hand side, if you look at it from an investment perspective, it's like a cliche, I'm sick of throwing money away on rent, buying is always better than renting, your home is your biggest investment, housing is booming now. Those are quotes that you sometimes hear. If you want, I can provide you with another spreadsheet, and you could calculate even, because it is sometimes a better investment if you rent it out, you bought something and you rent out something else. It is a better investment because you get subsidized by the government, so it is a better investment. And as I said, if you want, I can give you a spreadsheet on that as well, which is not that crucial. That's something additional if you want. So you should promise me the following, or you should promise yourself in the end, not me. You will get 2 spreadsheets, and you will actually fill out your cash flow, cash in, cash out. You will actually have a balance sheet then that defines your income and cost. And that's what you should do, because otherwise, we will do some fun stuff tomorrow. Otherwise, and you don't have to do that for tomorrow, that takes a couple of hours, but you should do that. Otherwise, you can never do those things that I have shown you with Frog before, because nobody is taking you serious if you actually don't know the absolute basics. Sorry for being so harsh. And And this is just another recommendation. Maybe you do that already. You can do that with less accounts, but it's like really easy stuff. I don't know how many of you actually have something like a 4-account strategy. It basically means that you have multiple bank accounts. And you have one bank account where everything comes in and your fixed cost, like your rent for an apartment, goes out. So you first have to write that down, what goes out every month. I'm not talking about like if you buy groceries, I'm talking about the fixed cost that you have in place, like electricity bill, apartment cost, etc. And that goes in and out from that account. Then you have another account, and you immediately, because you know actually what you have every month left, and you turn it into investment. So that amount, 10, 20, 30, 40% of your income will actually go to investments. And it has nothing to do with how much money you actually earn. It's even easier for some people who are younger, who don't have kids and blah, 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 to actually save 40%. And we have to differentiate between investment and savings. You should have some rainy day money. Like I, for example, recommend that you have, if you know your spendings for a month, that you actually have 3 to 6 times of your spendings as on your savings account. So whenever something bad happens, you can actually tell everybody, fuck off, I don't care, I don't want to pressure myself, but I can live from that money 3 or 6 months. And as a fourth one, you have an account, and there goes the money for your daily spending. So everything that you have as a consumer good, I'm not saying you should limit yourself, I'm just saying it is an account, and it's like, okay, I'm going to have a cocktail tonight, I don't care, pay from that account. That's basically a 4-account strategy. So from an investment perspective, what do you think is good debt and, I still struggle with that word, it's horrible after all those years, bad debt and the gray area. So as you can probably tell, like clothes, consumables, and other goods and services are usually, if you actually go into minus and you spend more money than you have, it's actually fucked up if you do that. Unless, probably, you sell off an off-white sweater the next day for free, and then it's a high risk, you can do that. Then it's probably good, but on the other hand side, education is always good because it pays off. I mean, every investment that I did myself, and hopefully you as well, while sitting here, is a good investment because it pays off later on. I did that multiple times. Every time, do that. It's good to spend your money. It's not promoting the school here only, but somebody likes that. But I tell you, it pays off. And real estate and investing into stocks, bonds, commodities, and futures and all that jazz is probably the next thing. So that's my personal feel. It's maybe a very German view as well. But I always recommend don't have any debt at all. Zero. Zero. Not even, that's me, not even for an investment, unless there are some exceptions which I'm going to talk about, but don't go into minus. So when you start having now that overview on your spendings and how much money you can invest, the next question is, okay, I now know I want to invest into something. It is not recommendation, do exactly something like that, because that's what John was saying before. He asked you to do a following thing, and it's not about, okay, yes, we execute on that and we do. I mean, you have to understand the situation and you have to act accordingly to it, out of your own perception. And the question is then, that's a tough part, you have to define how risky you are as a person when it comes to an investment. So are you, for example, I still wonder if he actually, you know, for someone with a bald head, you know, it's always the question, did Elon Musk actually make his hair? Like, did he, because that's an older picture and I think he has less hair than he has right now. Anyway, the question is, what is your risk tolerance, your individual risk tolerance? And if you're like, the type of guy, type of person, as long as I outperform inflation, I'm fine. Probably you should look first up what's inflation and how big is the inflation in your country. Because seriously, it sounds stupid. I didn't know like 20 years back or so. I never cared. So because if you're like, oh, I want to play safe, because my investment is when I was a kid, and you actually put money on your bank account, you got like a 5% interest rate back. Great. And then you actually were like investing, which was good. This is how I was raised. It's good to put your money on a bank account. I mean, honestly speaking here, inflation is roughly 2%, depending on the country. But in most European countries, more or less like that, temporarily. And you get currently, like in Germany at least, you get 0.001%. That's 1 0 too much. 0.01% interest rate. So basically, if you put your money there and you have an inflation of 2.7%, you're losing money. That's it's good if you have like a backup plan if you run into issues, but it's not an investment. It's actually crap, right? So I'm interested in long-term investments with steady growth. This might be the moment where you actually say, like, real estate is my thing. And I'm gonna, I'm currently living in Munich. I think currently you pay about, for 80 square meters, no matter actually where in Munich, you pay about up to 1 million for crap, €1 million. If you want to go for that, hey, that's great, as a long-term investment. And it's probably not as risky, but I'm going to talk about that besides about drugs tomorrow and wine and stuff like that as an investment. Also about some type of real estate, but that's a spoiler for tomorrow. But you might be the kind of person that takes more risk. And if you want to know, for example, that's an old company I invested in called Boo.com. You probably don't remember because it was before the .com bubble actually burst. So I was like, wow, all those great tech companies, super great. Only Amazon survived in the end, or kinda. I invested some money into stocks. They went public. It was a total disaster. It was all up in flames and I lost the money and stuff like that. It's not a bad thing to actually invest into stocks. That's a follow-up session. But actually, okay, I played cool and I actually lost some money there on Boo.com. Does anybody know this, Boo.com? John, you also don't remember Boo.com? They had great avatars on their website, on their e-commerce website, like waving. Anyway, if you're like super risky, then you probably say like, oh, I want 6,000% of interest rate. It's all about the play money, etc. Do you have a guess what that kind of investment could be? 6,000%. Yeah, we have all the cliches in here. Used to be Bitcoin at a certain time. Bitcoins back then. Which is true. I mean, you could even, in the beginning, you could even mine. You could turn on your computer and you could mine a Bitcoin and you owned the Bitcoin. Unfortunately, a lot of people didn't keep the hard drive or anything like that, or didn't write down too much into detail. Anyway, there was a chance at a certain time to have even higher than 6,000% an interest rate. And you have to be aware, I mean, I think risk is a good thing, and you should dare to take risk. But how high the level of risk is, and like super risky, certain percent, less risk, this is something that you have to define and you have to learn. And the good thing is, I don't agree with this guy. He wrote a book, which is nice to read, Rich Dad, Poor Dad, from Robert Kiyosaki. It's a nice story from this guy, how he grew up with basically two fathers, his real father, who was an academic, and then a father of a friend who was an investment manager, and balancing those two perspectives. It's a really nice story. I can highly recommend to get that book. I think sometimes even for free on Amazon Digital Prime. But I don't agree what he's saying here, because you can actually reduce risk if you do a so-called diversification of investments. Because what you can do, I mean, you don't have to go through all the text, and it's probably nice that I wrote that down, hopefully for you later on to read. But it's quite easy. If you want to put all your eggs into one basket, right, there's a high risk that this is going to crack. So you actually try to diversify. And this could be by, there are things that you can diversify, like for example, you can diversify your business and lower your business risk and financial risk because you spread it out through multiple investments, even with a tiny amount of money. But there are things that you can't actually, like exchange rates, political instability, war and interest rates, they're not diversible. They cannot be diversified. But you can actually, for example, decide where you do your investment. So if you only bet against US dollars, it's probably a bad thing, because if US actually goes up in flames, it might be a bad thing because other economies will actually suffer from that as well. So you can influence that as well. And how you should actually start, this is a very simple thing. This is again a thing that you should do after you've done the previous things. You should just, first time that you do that, do this and just think like, divide between high and low risk. High risk, I don't fucking care if that money burns the next day. I mean, you do care, but you should think about like, I'm not actually dependent on that money if that goes up in flames. If you say like, ooh, 5%, not more from my well-earned money, then it's fine as well. Then you have a 5% high risk and a 95% low risk ratio. And you can invest into that. Low risk is obviously putting that on a savings account, putting the money hopefully under your pillow, right? That's a low risk. A higher risk, dependent on how you can be out of your guts investing into Bitcoin, but it can also be stocks. I mean, in reality, the risk is very different, but it's according in that first investment plan that you do, it is that. And then you actually, if you have more experience, and this is what you should do, I highly recommend, I mean, you can talk to people, like some sort of advisors, but if you don't understand the basics, I mean, not all of them are bad, but you should understand what you're doing, just as a cross-check. And if you're on that level, after that level, you should do the following. You can actually define, okay, I still probably have a ratio on risk and lower risk and high risk. So stocks might be a higher risk. Commodities is, like for example, into a government might be a lower risk. Bonds might be lower risk. Real estate might be a low risk. That's already too much details, but you should actually work on that investment portfolio until you probably can diversify, no matter if you don't know what this means right now. But this is your progress, going from here to there over time. And then there are different types of, this is funnily, if you ever went to an insurance company, bank or whatever, this is basically what they do, right? You actually answer some sort of questions, and then they come up with this round circle and actually tell you, yeah, this is for investment for high risk. And you don't have a fucking clue what they're doing there. So they take mostly the fast path and they come up with a different recommendation. Again, I highly recommend that whatever you do, don't do anything that you don't understand. Sounds stupid, but it is like that. So let's talk about goals. You should, after you've done first the two spreadsheets, then actually your fancy round circle on your risk behavior, you should do and define some financial goals. And I think on the next chart, we'll show anyway, you will get a spreadsheet on that as well. And I do that, for example, I adjust that every year. In financial goals, I do that for my job, actually for my personal progress, because I do that for 1, 3, and 5 years. And I start with the 5 years. Where do I want to be in 5 years? And then I actually break it down into the action that I have to do. Like it could be within my job, educational program that I'm going to join, because I want to be with a goal in 5 years the following, and I actually plan out the steps to get there. And from a financial perspective, you can actually do the same. If you want to achieve in 5 years, I save 200K or whatever, or 10K, doesn't matter. Depends again on the ratio that you want to save. And this is why you have to do previous work. You want to have, in 5 years, 10 apartments. You want to have the following know-how, or even a team. When you have to put it into a numeric definition, like 5 or 10 or whatever, a timing definition, which is the 5, 3, or 1 year, it should be executable, and it should be written down. If you don't do that, you lose track. So the big thing with investments in general is that you have a plan, and then that you stay cool, that you actually execute on that. Because the worst thing, and this is nice for others, because if a stock goes down, right, everybody panics and is like, oh yeah, because I watched those Hollywood movies, and now I want to sell, because everybody else is selling. Usually, with most investments, unless they file bankruptcy, as with Boo.com, it goes up again. And you usually buy when it's really down. You invest. But actually dealing with that feeling, and it happened to me in 2008, when you actually figure out like 40, 50, 60% down, it really feels horrible. But you have to stick actually to your plan. First, a very simple plan, but you have to stick to that and don't change it. I only do that once a year, me personally. I mean, you can do whatever the fuck you want, but me personally giving some views. Yeah, spreadsheet you will get. There are actually a lot of books out there in the market and articles. You probably have heard about the term financial freedom. Did you hear that before in an article? Financial freedom, I want to have financial freedom, and living on an island in, I don't know, Thailand. It's actually interesting how you define financial freedom in reality, because there are 3 terminologies that you should keep in mind. You have financial protection. If you have, I said 3 to 6, in that case it's written 6. 6 times the monthly fixed cost that you have saved somewhere on a bank account. How much? 6 times. If you have like that nice spreadsheet and you know all your monthly spendings and you squeeze it out, you should, by the way, optimize it, because that's an advantage if you actually write down all the things. You have to ask yourself, and I think I didn't mention it before. Pardon?
If I don't have it, I'm fucked. If I do not have this, am I fucked?
In multiple ways. And now it gets interesting, because when you talk about financial safety, and it says 150, it says 150 there, it's not a mistake. Financial safety basically means 150 times your monthly fixed cost, 150, to cover cost by interest rate. So you live by the interest rate. And seriously, this is doable. Seriously, I'm dead serious. I'm dead serious. This is doable. You can do that. I can even show you, I don't have it prepared now, but if you want, I can show it to you mathematically. We can go through it. That's another thing. Start early. That's definitely. And financial freedom, by the way, by definition, that's why it's such a bullshit word, means 150 times your desired amount. It's not what you currently spend. It's like, oh, actually, I don't need 3K a month, or 4 or 5 or 2 or 1. It doesn't matter. I actually need 10K a month, and that's multiplied by 150 times then to have your financial freedom. That's a tough one. So, lastly, how can you automate your cash flow? And there is a difference between active income and passive income. We have a lot of text, but it's quite easy, just with a picture. Active income is exactly this, right? And active income basically means that you have to work to actually get some cash in, right? I assume some of you exactly do that. A passive income basically means you're doing this, and cash comes in. To quote a favorite guy who drinks Coca-Cola every day and eats a hamburger each one a day, Warren Buffett, if you don't find a way to make money while you sleep, you will work until you die. So, and let me sketch out one last thing. I don't have it in here because it's bugging me right now. It's also from that guy that I didn't like before with Rich Dad, Poor Dad. So I stole it from him. It's the so-called cash quadrant. This should be 4 quadrants, by the way. And the first quadrant, this one, is basically you as an employee, right? And as you know, this is how I got educated. Get a good job. And probably within time, you actually go like, you make your parfum sometimes here, and then you probably end up with a very nice job as an employee, right? Right? The difference is this cash quadrant is you as, let's say, a freelancer. So, we know some freelancers, probably currently, they earn, not all, by far not all, they earn more each day. Because here you probably work 16 hours. Here you probably work 16 hours as well, but you get a higher hourly rate. Right? Now, on the other hand side, number 3, it is you as someone who built a company on your own. Right? So it's like you, company on your own, and now capitalism strikes. You have some employees, they probably earn less, and this is actually more money that you can earn, because others are actually they should be happy, but they're earning the money for you. So this is how you can scale. And the fourth one is actually you as an investor, because you probably can take all that. If you're successful and don't fail, you can invest that money. And you probably only do the thing like lying in a, I don't know. The interesting part is, I think we get educated a lot, at least in Germany, maybe you say in your country it's different, on this side, right? Or even in here. But this is actually the interesting side, where you can really scale and really make money, because this side is limited. And you will recognize that at a certain point, I'm quite sure, this will be limit yourself up to a certain point. You can be very happy with it, don't get me wrong. I'm just looking at it from an investment perspective, and I just stole that from another guy, so it's not my thinking. But I just wanted to share that with you, according also to what Warren Buffett is saying here. So, As a last slide, I want to repeat what you should do. You should write down your personal cash flow. You should write down your personal balance sheet. And then you should write down, and you have a spreadsheet for that as well, 5 ways how you could increase your income. And it might be, I tell you, if you write down all that list on your spendings, you have to ask yourself, do I really need that crap? Right? And then it's already like you increased your income because you just cut something out. Sorry, I fucked up. I fucked up the bullet points. Actually, this one is truly how you could increase your income because I want to get promoted in in the next year or in 3 years. This one was writing down 5 steps how you could decrease your cost, which I just explained. And the last one is you should define your personal financial goals in that huge spreadsheet.